All right, folks. Glad we're all inside and dry, if not a little cold. Hopefully the lively discussion will heat everybody up. My name is Eddie Tai. I am a partner with 500 Startups. 500 Startups is a global venture capital firm headquartered in San Francisco, but I've been here in Vietnam for the last 6 years. So very happy to welcome Horasis here into Vietnam for the first time. In a moment, we'll go around and have all the speakers intro themselves. But first, I wanted to get a quick poll of the other folks in the room to get a sense of where you're coming from. So if you are currently an investor in startups, whether as a venture capital firm or an angel investor, could you raise your hand for me? Currently a venture capital investor. Hopefully a couple people in the panel as well. All right. If you are a entrepreneur, a founder looking for venture capital, could you raise your hand? Okay. More of you, so that's good for the investors. All right, and last question is, if you are neither currently a venture capital investor or founder, but you're still listening to what I'm saying, raise your hand. Okay, so the other people are not listening. Hopefully the other interesting speakers will help get your attention. So let's do a quick round of intros. We can start on this side and work our way around. Mr. Kuwajima.
My name is Hiroaki Kuwajima from Japan. I'm based in Tokyo and also San Francisco. So my firm is basically $100 million fund managing the Japanese corporations' money, particularly in Silicon Valley, but also other parts of the world. I'm very happy to talk to you, everybody. Thank you.
Good morning, everybody. My name is Virginia. I'm the founding partner of Dich Ventures, which is a new venture capital fund focusing on China and Southeast Asia. I'm Singaporean, but I'm based in Beijing for the last 6 years. My background was in that I moved to China in 2013 to work on One Belt, One Road strategic investments representing the Chinese government. And then, over the years, based on what we basically did in China, we decided to build this fund. Our specific focus is in fintech, edtech, the content economy, as well as online to offline consumption and consumption upgrades in these markets. Thank you.
Hi, my name is Vaibhav Singh. I am an entrepreneur. I run an analytics business which basically uses machine learning and deep learning in creating algorithmic predictive models which help optimize inpatient healthcare delivery. Based out of New Delhi in India in an engineering school funded by a venture capitalist based out of the Valley. Prior to this, I was running investments, heading the New Delhi office for a large-size private equity fund managing $2 billion in India. I'm a chartered accountant and MBA by qualification, and it's a pleasure to be here on this panel. Thank you.
My name is Martin Hemmick. I am an academic these days. I was in industry for the first 17 years of my business life, last 17 years back in academia, specializing on the globalization of venture capital, corporate venture capital, and technology startups going global and collaborative innovation between startups and big multinationals. And I'm also an angel investor. I'm usually writing the first check in very deep tech, global, born day one startups. And how to take them global and so on is something I'm teaching, researching, practicing. So at Stanford, we did a research for the World Economic Forum, which I was the founding member of the venture capital group 14 years ago, and did it for 11 years in Davos. And we looked at 380,000 startups in 26 countries on successful growth strategies. So I'm happy to share some of those insights today. And I benchmark the venture capital industry on a quarterly basis, nation by nation, on the top 15 innovation hotbeds in the world.
Morning, I'm Jeff Char. I'm currently an entrepreneur running a new renewable startup company called Trendy in Japan. Prior to that, I spent 3 years heading up the venture capital team at Tokyo Electric Power in Japan. And then before that, I spent 20 years starting companies. Thanks.
Good morning, ladies and gentlemen. First of all, let me thank all of you to take your valuable time and come for this panel. Thank you very much. I am Lieutenant Commander Arun. I am a military veteran from Indian Navy. After my engagement with the Indian Navy, then I moved out to my civil world, and I came back to my hometown, a place called Kerala in India. Understand the potential, the resources availability, the employees availability, the talent availability over there. Then I thought I must contribute back to my state by providing adequate support to the startup ecosystem out there. So I took a place which was a tier 3 destination, create an IT park, bring all the startups over there and help them to scale up the business. So nurturing startups, helping them to get the market, providing them the business, and helping them to raise fund. That is the primary objective. Thank you.
Great. Thank you for your intros. Very diverse backgrounds, as we can see. I'm looking forward to hearing from them. But first, I have asked Martin to prepare an update on the status of venture capital worldwide. He could actually cover the whole panel just by himself, but I've asked him to keep it just to a few minutes. So.
Okay, thanks, Ed. You better signal me when I start going into orbit here. So since I researched the venture capital industry globally, there's an absolute phenomenon happening at this point in time that it looks like this year or next year, China is overtaking the United States in absolute dollar investments, not in terms of number of deals, but absolute numbers in terms of dollars. And I'm coming back to this. So the way it looks like that is the China and the US are pretty much at about 80% of all dollars invested this year in the first 3 quarters of this year. That's pretty stunning. So Europe is down to about 10%, and the rest of the world is the balance, which is another 10%.
And how much is that total?
So this year is likely gonna hit about close to 200 billion this year, close to 200 billion. And I'm asking Eddie afterwards to put Vietnam into perspective to this, just to make very clear. The other thing that is surprising in terms of within Asia, now we're in Asia, so let me focus quick on Asia. So about 3/4 of all the deal done in Asia are actually still is China. And it's about 86%, and that's for the first half this year, right? About 86% of the dollars that go in is also China. So this is the big elephant. If you take that out of the equation, I think then we can talk another ball game here. The same thing when it comes to unicorns. Silicon Valley in itself, by mid this year, has about 57 active unicorns still privately held. Beijing 29, which is half of what Beijing alone. I'm not even taking Shanghai and so on into consideration. Europe is about at the size, in terms of unicorns, of Beijing alone. And then if you look at India, India has currently about 12 unicorns. And again, that's about a bit less than half of Europe. So just to put this a little bit into perspective, I think something else that is significant and dramatic, China, the US, and Israel, when it comes to the average median round size, are probably about 4 to 5 times higher than any other nation, including entire average median of Europe in between. 4 to 5 times, that's a median round size. And that's a very important message, because I'm coming back to this in a minute. When it comes to exits is other interesting. The large exits above 100 million. So if you put a lot of money in, you better have large exits. So if I just pick up Silicon Valley in the last 5-6 years, they had about 250 exits at above $100 million. And then the first non-American is London with 49, Beijing with 34, and so on and so forth. And Israel is always mentioned, so Tel Aviv is 19. But taking this into consideration of startups going international, global, that's really something that is key. And I can tell you, the more technology is involved, the more those startups need to go international. Why? In the smaller nations, the absorption capacity to take on their technology is too small, so they are bound to go international and global. And when I look at the companies that go international or global, and it's still a significant portion in the very high end of tech that still goes to Silicon Valley. And it's particularly currently AI, machine learning, new computing platforms from all over the world. A large bulk ends up in Silicon Valley. And just the last 2.5 years is very surprising. The proportion that goes to Silicon Valley has increased from 31% of all startups going to the US to 40% back again. So it was on a downslope, now it's coming back. The timing of going international and global, we'll talk maybe on a panel later, but all I can tell you is the most successful companies that made it to Silicon Valley went immediately, when they were cutting edge domestically, and went to the market with 3-4 paying customers. Then they went to Silicon Valley and they made it. If they go after Series A, Series B, it's 2-3 years too late to the valley and the market is eaten up. And they're becoming a silly me too, and no more than that. And then when it comes to exit, this is something that I have not published it, but you're the first guys I'm actually sharing this because I just finished the research. It's not published yet, but companies that have a foreign office, so it's not internet sales, but seriously on ground on R&D overseas, included business development and sales. If you have those startups with an international office and they exit either through an IPO or an M&A, and this is a magic number, even for me, a huge surprise, I can tell you the following. I looked at 5,500 exits. So it's a huge number around the world I looked at. And I look at IPOs. So I compare startups against their peers, the ones that went international and the ones that stayed. And if you look at exit multiples, valuations, the valuation on IPOs is 16% higher of the ones that exit internationally than the ones that stays domestically, with the exception of China. So I'm saying, and with the exception of very large unicorns, which are in US, you better stay in US, right? Other than that, it's 16% higher. It's even more amazing when it comes to acquisitions. So 24% of all acquisitions happens outside the headquarters of the startup. And the exit value, this is dramatic, I love it. It's 51% higher if you get acquired by a foreign corporate. And why is that? There are two phenomena behind this. One is they want access to the market and or access to the technology, and that they're willing to pay a premium. And so why is the multiple also that higher? It's because the round sizes and the valuation in early stages outside their home country is typically much lower, and a large bulk of tech companies get acquired by American corporates, actually, or by Chinese, and these guys are paying a super premium for that. So all that said, I think I will stop here for the moment. Only one last item. We need to talk about corporate venturing as part of the ecosystem. 19% of all deals done in the first 3 quarters this year around the world included a corporate investor. However, they were involved in 47% of the total aggregate dollars that went into those startups. So they're also writing much larger checks on top of it. So that's enough for the moment, and I'm handing back to Eddie.
Thank you, Martin. I think what he tried to do was squeeze in his hour-long lecture into 5 minutes for us. So let's try to spend the rest of the time unpacking some of that, those very interesting themes. Obviously, at the biggest level to me, one observation is that there is a lot of money going into venture around the world, obviously weighted in China and the US in particular, but it's in multiple countries. So The description of the event suggests how can we ensure that innovative firms have easier access to finance at earlier stages, but actually perhaps that's no longer the right question. Maybe there is enough money going in, at least at the whole. But there are probably in geography variations. We can see San Francisco and Beijing have, from Martin's sharing, have very easy access to capital, but places like Kerala and Vietnam have less access. So Martin's referenced that, and I'll very quick stats from my end, I would give some perspective on what's happening in Vietnam. There's about $200 billion of venture capital worldwide. In Vietnam, there's about 200 to 300 million US dollars per year. So 1/1000th, 0.1% of total venture is happening in Vietnam. Acquisitions are, exits generally. There are exits happening, but virtually no tech startup IPOs coming from Vietnam. It's all M&A and it's all small scale. The bright side for Vietnam, though, is its share of exits in Southeast Asia is rising. Back more than 5 years ago, Vietnam accounted for 2% of tech M&A exits in Southeast Asia. Nowadays, it accounts for 15 to 20% of exits each year. The exits are still small, but the share is increasing, and that's a healthy signal for the Vietnam ecosystem. So anyway, that's to show you that although venture is very active around the world, it is not evenly distributed. So I wanted to go and deep dive a little more into the Kerala example and say how are governments and the private sector able to work together to fix this situation in the kind of frontier markets.
Thank you, Adi. So in Kerala perspective, when you talk about Kerala, and it's a 30 million population in Kerala, and surprisingly, you see one of the most advanced educationally, premier educational institutes like IIT, Hiem, in the standard of Harvard, Cambridge type of institutions are there in Kerala. The STEM talents, the science, technology, English, mathematics talent, resources are available in plenty. The resources coming out, the employability quotient of the resources are too high. And there are a lot of advantage factors as a state is concerned. The first digital state in the country, less in infant mortality, high in life expectancy, a state, a group of people with high caliber. Now, we had seen the struggling of the startup phase. I had seen them when I am interacting with the startup community. The challenges they faced was a correct podium where they can come and work. Most of them were working in small one-room places where they don't have any access to the entrepreneurs, access to the mentors and all. So what we did was to create a place where all these startups can come and sit and work in a business environment. We provide them the business environment, and we also help them to connect with the mentors. The main challenge with startups I had seen on the initial stage itself, around 50% of mortality. With the initial, that spirit, they come and died off within 1.5 years, 2 years. Then the government realized that this is the time where we need to give the maximum support to the startup. Then the first thing which the government did was provide them the infrastructure, a place where they can come, sit, collaborate and work together. So once that is being attained, a group of people with same set of goal, same set of belief, working in one place, create that ecosystem. Then that start moving on. Now again, the next step was to, when the idea is coming out, the next step was to how these people can access to the capital, access to the fund. The access to the fund is the access to opportunity. So government brought a group of entrepreneurs, especially the Keralites who are working extremely well in most of the places in the US, Europe and all. So we try to bring all those people to get back to our state and contribute to the ecosystem. So these people came and tried to adopt a couple of companies and nurture them. Then they realized that the correct mentoring, if it can be done, we can change a tectonic change can happen. So there are a lot of success stories. In my park itself, I had seen a company founded by 4 youngsters called Profoundis, which has been acquired by a US company called Full Contact. Byju's app story will be very familiar. So now the people, the government again, they realize that we have to focus, we have to clear about our vision. Whether we are looking for a few billion-dollar company or a few companies which create thousands of jobs or hundreds of companies which creates hundreds of jobs. So the main aim was to get the VCs. So generally when I interacted with these VCs, the VCs just pump money to the small and medium scale companies. They don't look at the startups. Of course, the quantum is very, very less. So now we suggested we don't want to pump money. We need to sprinkle money to startups. Let VCs come sprinkle money so that every startup, out of around 100%, 100 startups, there may be success rate maybe around 20-25%. But you are giving an opportunity to the startups to come up to the mainstream. So that the government is setting up this initiative so that all the startups will get access to the angel investors, VCs, and parallelly, we are trying to bring major MNCs to the state, ensuring when a major MNC comes to our state, that itself is a testimony that this is a conducive business environment for other companies to come and follow. Now, Nissan is setting up as Asia's largest R&D hub in Kerala. Major companies like Fujitsu, Amazon, all of these people are exploring Kerala as the upcoming destination. Now the government focus is to adapt to the new technologies like artificial intelligence, blockchain, IoT, so that we give a commitment. The government gave a commitment to the company saying that we will provide the talent. 5,000 resources will be provided to the company. So that gave the companies the assurance that the government is very proactive, the resources are available. When the resources are available, definitely we would like to come and set up the shops. That is the primary focus. Now, next thing again, the point of discussion is how innovative startups, again, can more access to the funds. I suggest maybe an utopian idea. I would like to think about why we don't think about an ICO or crowdfunding, where you give an opportunity, you get an opportunity like a company working in India, getting access, company working in India, employees working in Africa and America in the same company, with investors across the globe, pumping hundreds or thousands of rupees, don't need to put millions and billions, coming, giving an opportunity for the investors, small and medium and bigger scale investors. The problem with what we faced is that most of the venture capitalists are accredited venture capitalists, and they are only get the opportunity to invest. There are small and medium scale people who would like to invest. So this platform will give them the opportunity, small and medium scale investors to invest, and also help the startups to open the global market, global accessibility to the fund. So that is the one thing which I want to take it forward. I would like to know the opinions, how a crowdfunding through a digital currency, there are a lot of challenges there, which if there is a challenge, it's our responsibility as a collective to come and overcome it. If there is a challenge, you have to find an opportunity. So I would like to discuss with all of you how this ICO can help innovative startup to raise more and more funds. Thank you.
Oh, ICOs are a hairy topic. Let me set that aside for now. May I ask how long you've been working on these initiatives in Kerala?
See, I've been working with the Kerala IT ecosystem for the last 8 years.
8 years.
So I had seen this, the struggling of startups from the initial stage. Now I had seen a lot of progress because of the proactiveness of the government, and the entrepreneurs are coming back. Like now I had seen Tata's and all those type of new investors like NR, Narayana Murthy, Infosys founders, Wipro founders, all these people are coming back and setting up their VCs to help the startup. The advantage is that their experiences can also be shared to them, and their network can also be explored to the startup market.
Do you have a quantitative sense of how much capital is coming into Kerala now, venture capital?
Sorry, I don't have the data on how much VCs is coming. When I came over here, I was discussing about most of the VCs over here. Did your radar is there on Kerala or not? Some of them knew about Kerala. Some of them considered this as a tourist destination. Despite of having enough resources available over there, it's now the same thing that we need to market it. the availability of resources, the availability of educational institutions, the opportunity is there. It's being the southern tip of India, so it has been lately ignored by most of the VCs.
Okay. I've heard some similarities in what you've described about the Kerala case with Ho Chi Minh City and Hanoi as well. The availability of tech talent, the youth, the generally growing economy. But I think I visited Kerala last year for Horasis Asia. There's probably some work to go for there as is here. Whereas in Jakarta, their Indonesia, the venture capital scene has exploded over the last few years. There are now a number of unicorns where previously, 5-10 years ago, people would not necessarily have expected that. So I wanted to get a sense for how did Indonesia get to the inflection point? What were the key factors that made it successful beyond the early stuff of physical infrastructure development, of inviting ecosystem people to the city or the broader country? What were the big turning points for the Indonesia story?
Thanks, Eddie. We are a new player in the venture space, and our two key markets are China and Indonesia. So what I want to talk about is sort of what we see, in terms of opportunities in Indonesia today, and sort of the challenges that we also see as a market. So how did Indonesia get to where it is today? I mean, I think if you look at just general population demographics, Indonesia has a population of about 240 million people, the fourth largest population in the world. I think they are seeing by 2030. I heard the Indonesian President Jokowi speak about their growth projections, and I think in 2030. They expect Indonesia to be the 8th largest economy in the world. They also have a fairly youthful population, so Indonesia is expecting to reap the benefits of the, what we call the population or the youth dividend, as well as one of the highest rates of mobile penetration, in Asia, which I believe is more than 100%, because I think it's often that, an Indonesian person owns more than one mobile phone. So these are some of the sort of the general trends that we see. I think in terms of Southeast Asia, everybody is aware that we are in a fragmented market. So 10 ASEAN countries, apart from, I would say, Singapore, every single ASEAN country with its unique demographic and language, which means that if you are, if as a venture capitalist, if you're looking at sort of, the big ticket exits, which is what every single venture capitalist wants to look for, you are trying to figure out, where, first of all, what is a regional play? And if not a regional play, then which market obviously looks the best? And for now, that's why, I see almost every major Southeast Asian fund or family office which wants to focus on Asia, relocating to Jakarta. But I've actually only seen this in the last 9 months to a year. And recently, I was in Jakarta, and I see that flurry. Where do I see, the unique opportunities, or where do I see the gaps, which in turn are opportunities? In every single market, I think the funding gap is a little bit different. I think in the last couple of years, I think in Indonesia right now, there are about less than 20 active venture capital funds, and I would say in terms of top funds, less than 10. I would say less than 10. Where I see, where the funding gap comes into play. In the past, when venture capital was nascent in Southeast Asia, you would see it in the early stages. Now, where I see the crunch is in sort of like the B round. After startups, get to a certain size, A+. What I'm seeing from founders a lot is that, okay, in the early rounds, it's not difficult to get sort of local venture capital money in, but then when it comes to sort of B round and you're looking from the $5 to $10+ million checks, then they're basically looking out towards the region, at bigger regional players. And the other thing I was going to say is that if you look at 2017 statistics, you would have seen that 95% of venture capital in 2017 actually came from China alone. Which is quite interesting. When I was based in China doing One Belt One Road investments, I moved there in 2013, which is caught the wave of seeing all the Chinese tech giants sort of emerge and really explode. For example, 2013 is when WeChat Pay was launched, when Didi, the ride-sharing service was also launched, when payments actually really took off across China. And with One Belt One Road, we were also first to see how Chinese capital went outbound, first on a sovereign and infrastructure level, and then increasingly in terms of private equity and then in venture. So you saw a number of strategic sort of acquisitions as well as investments from China into the region. Alibaba bought Lazada, for example. You see strategic investment, for example, JD.com, which is Alibaba's biggest rival, invest into Traveloka. You see Tencent putting money into Gojek, and if I may say, Gojek's product day by day looks more and more like WeChat in terms of its services. What I also see is that because of the weakness, the inherent weakness in the Southeast Asian capital markets, I mean, in terms of if you're looking at pure listings, I think when venture capitalists think of exits, traditionally you would think, okay, IPOs, but actually we really query, how many IPOs in Southeast Asia we're going to see from Southeast Asian giants. I mean, apart from, I would say, the few really notable ones which we think will list at some point. I think right now in Indonesia there are 4 unicorns: Bukalapak, Tokopedia, both e-commerce. You see Traveloka, which is sort of the Expedia of Southeast Asia, and you see Gojek, which is the ride-sharing but turning into a multi-services platform. I think in Southeast Asia alone, I think less than really 10 unicorns. So the question for us is, okay, so your money goes in, but how is your money going to come out? If it's not going to be an IPO, then really what I see is that in terms of exits, you're really looking at strategic investments or acquisitions by 4 potential players. We see the Chinese, the Japanese, and the Koreans with much more interest in the market, especially in Indonesia, as well as potentially large Indonesian conglomerates who are very, very interested in sort of a lot of like some of the companies I'm looking at, even at an early stage, are being offered to be bought out. Especially any tech platforms offered to be bought up by the conglomerates. Something as well very interesting in terms of Indonesia, and you see a little bit of that trend in China as well, is that we need to remember that Southeast Asia is still sort of a land of a lot of traditional industries, food, example for one. And what I see in Indonesia, for example, one of the largest A-round tickets in Indonesia recently was in Kuningan coffee. It was $8 million for an A, which is a large A in Indonesia by Alpha. So we also see that it's not just a pure tech play, in Southeast Asia. And very often, it's online to offline consumption enabled by technology. I think I saw something recently in Cambodia, which is like an online-offline food kind of delivery or catering type services. And I think in terms of challenges, I think a few things. I think it's so interesting being based in China because you see in a way, I mean, there's similarities and also differences between China and Southeast Asia. I think the Southeast Asian tech ecosystem probably is about 5 to 10 years behind China. And there are similarities between the two ecosystems, not completely the same, but certain consumer profile and sort of consumer preference type similarities. And I think what is very interesting to note, or for me as a venture capitalist, is to figure out, can we spot actually the next trend? Is it going to go something like China, or is it going to be, a little different? And if it's going to be different, how can we leverage, what China and other more mature players like Japan, etc., have already done in terms of mature business models, in terms of mature technology? Can Southeast Asia actually leverage that? Can we bring a very mature product into some of these markets and localize it? So these are some of the, these are some of the opportunities that I'm looking at. In terms of AI and machine learning, of which is all the rage in China these days. And in fact, the big opportunities in China in terms of machine learning and AI are actually really in the B2B sector, not just, because I think the B2C sector is actually pretty saturated in China. I still think that we are very early, very, very early in Southeast Asia in terms of AI and machine learning, and even in places like Indonesia, which I think has seen, like a bubble, not a bubble, but like an explosion of activity in the last, I would say, even the last, 2 years. I still see, it's just, honestly, just using technology to just change or improve very traditional industries. A lot of the basic things have not been done. For example, college platforms, preparing you for university, online courses like the type like Coursera. These are the kinds of things I'm seeing. All kinds of supply and demand and fintech, like basic sort of payments type platforms. So I think for a while, a lot of the opportunities are still not necessarily in the super AI or machine learning space, but actually more in digitalizing actually, basic sort of, traditional industries.
That's right. Thanks for that. And I guess one encouraging thing that we can think about is 10 years ago, if we were having this discussion, people would be talking about will companies in Southeast Asia be able to follow the US's footsteps. But now China, in the last 10 years, has made such tremendous progress. Can that happen again in other countries? Is an interesting question. But I want to pull out something you said about how Indonesian firms, especially as they go later stage, start to look for funding from China, Japan, Korea, Singapore as well. We actually have two gentlemen on the panel from Japan, so I'd love to have you hop in on both on this theme of these wealthier countries looking for investment opportunities in emerging markets, but also talking about the Japan domestic venture market itself. One might expect an economy that is 5 times larger than Indonesia to have figured out venture capital access, but I can imagine there are actually some difficulties for innovative firms getting venture in Japan. So I would love for you both to comment, and I'll leave it to you who speaks first.
First of all, I just wanted to share about the current Japanese situation in terms of the venture capital investment. So unlike China and maybe even unlike Indonesia, Japan was kind of behind in terms of venture capital investment. But finally, Japan is becoming a kind of startup nation. Right now, we're going to have close to the $2 billion of the venture capital investment. It's far small compared to China and the US, but finally, the top talents, particularly the younger generations, are going to the startups. And also the number of venture capitals and also corporate venture capitalists, corporate CVCs are flourishing. So for the last 20 years, Japan was so struggling to make the startup ecosystem for long years. But finally, we solved first amount of the risk capital and also the amount of the human capital. Finally, the top talents are leaving from big companies and going to go to the startup ecosystem. So I think it's a good. So I just want to stress that Japan is also going to emerge. We have, again, the number is small, but we have a couple of unicorns in terms of the AI space and also the B2C marketplaces. So don't miss out Japan. That's the thing. That's the first message. And the couple of things, I think, but still Japan is even, we are kind of comparatively larger economy. We have a couple of still challenges. One is the lack of particularly in angel investment. In Japan, again, right now we have seen a lot of successful entrepreneurs, which maybe in Southeast Asia, in China, definitely going to experience. I think in China, it's already lots of the successful entrepreneurs who have money. But the issue for Japan, there's also lots of rich people, but they actually don't know how to invest in the startups in the early stage. So I think existing of just rich people, angels, that isn't enough. But I think for maybe tax or something, for them to incentivize to invest in the early stage startups, I think this is the very critical thing. On top of having accelerators, etc. And also, the other challenges is the scalability in two things. One is obviously, Japan is, the third largest economy. We have around like $6 trillion of GDP. So most of the Japanese startups tend to focus on Japan market first. But it's a kind of a trap, right? Because but again, if they focus on the Japan first, obviously when they go to like United States, even China, it's 2-3 years of the behind. So it's obviously in terms of the valuation, it tends to be Japan-focused valuation. So it just just a couple of $100 million, at the maximum, but it doesn't give enough incentives for Japanese entrepreneurs to go global. So I think how to educate entrepreneurs how to scaling up globally, it's also the big issue. And again, also the lack of professional talent, it's still the issue, even though the entrepreneurs are going to be professional, ex-McKinsey, ex-Goldman Sachs, the whole pool of professionals right now in Japan. But still, after they started startups, how to scale, even in terms of the domestically, it's a big issue. So I think how to establish kind of educational system to provide to make a stream of the professional talent into the startups, I think it's a common challenge in Japan. And just a couple of comments because I have my time I'm spending in Silicon Valley. So, particularly what I see in terms of why United States and startup ecosystem is strong, particularly for the risk capital. I think as Arun said, the U.S. government is actually playing a huge role, like Department of Defense, like there's a program called DALPA or SBIR. Actually, the U.S. government is providing the very early risk capital for the startups. Also to make a stamp, like a government stamp on the startups. Maybe this startup is particularly certified, but not certified, but at least stamped by the government. Maybe there's a potential for the investment, and also the existence of the capital from the universities. As you know, the Stanford University, for example, they made a huge money out of the first initial investment on Google. They had, I don't know if the figure is correct, but they made like a couple of $100 million only out of the Google investment. So I think in terms of the risk capital to the early stage startups, I think definitely not just angel investors, but also accelerators, like even universities. There's lots of people who can provide the risk money. So how to diversify the source of capital is going to be important, I think. Thank you.
Maybe I can add a little flavor to what Kuwajima-san just talked about. So historically, I'd say for the last 30 years or so, the vast majority of Japanese venture capital money has been tied up in large financial institutions. So the venture capital industry in Japan is primarily made up of subsidiaries of banks and life insurance companies and securities firms. The people running these firms are basically salaried employees. They have very limited upside in any deals, and if deals go sideways, they basically get bumped off the promotion track. So they're not really good at taking risk. There's not a lot of incentive for them to do so. So most of the money has been tied up in very domestic deals, and I would say they play the game not to lose rather than to win. But recently, I'd say within the last 10 years, that has been changing, and a growing number of venture capitalists have actually come out of startups, successful startups, and taking their own money and starting to seed invest, and then also being able to raise or attract money from other large institutions. So that's really changing the game. I think for Japan in itself, if there was more M&A, that we would see a faster growth in this trend, but actually we have very few M&A exits versus IPOs. I think when you have a successful IPO, people tend to stick around, whereas when you have M&A, oftentimes the folks who started the company and made money will leave and go start other companies, and the investors, of course, having been proven right that they invested and made money, are more actively inclined to invest again. And so I think if we have more M&A exits, that should accelerate this trend, but it's really still very nascent. And then lastly, my focus is on energy. So I've spent 20 years in IT, but for the last 3 years, I've been focusing exclusively on energy. I just raised $7 million for my startup. We brought in half of it from Japan. I'm sorry, 2/3 of it from Japan and 1/3 from overseas. And I only took on 3 strategic investors. Again, in the energy field, financial investors have been avoiding it. I think Kleiner Perkins got killed in clean tech, and that trend has kind of continued and dampened interest in the sector. So most investment in my area has been out of corporate venture capital, with the large utilities and power companies and oil companies and whatnot being interested in this field, but not financial investors.
Can I challenge my Japanese colleagues here?
Please.
I trained dozens of corporate venture capitalists in Japan. And what surprised me in Japan was that even the corporates, a lot of the corporates are very risk averse to going in early. They always say, come to me back when you have, a few customers proven and so on and so forth. which is the opposite. I can tell you the largest increase, as example, in the US is the corporates going into seed and angel rounds dramatically. And I'm waiting to see the Japanese, very risk-averse corporates going in that one. And I think that is a challenge. So adopting early, I think that needs to be fixed in Japan.
So I was doing that at Tokyo Electric. We invested in several overseas companies in Germany, in the UK, in the US, in energy sector, actually mostly software companies, but very early stage. Having said that, I've also watched many corporate venture capitalists in Japan kind of become aggressive, and then actually corporate agenda changes and the teams are disbanded, and this kind of just goes in this continuing cycle. And so whenever I see a new corporate venture capital team being set up in Japan, I start counting, because I'm imagining that within 3 years they're going to be disbanded. And I've seen this at multiple different companies, and even a second or third time around, where somebody will come up and then they'll decide this is their pet project and they want to innovate, and so they set the team up. Sure enough, 2-3 years down the road, the team's been gutted, the budgets are cut, and they disband the team.
Can I just respond a little bit? So I think that there's a tension, not just for the Japanese companies, but the financial returns versus the strategic returns. So it tends to be that for many cases for the corporates, like they want to have a strategic return. So if you invest in something, you have to get immediate return on their overall strategy back in the headquarters. So particularly, I see a lot of Japanese management, first of all. So particularly, even they don't understand the differences between the startup investment or the traditional M&As. Sometimes I see the discussion, in front of me that happening like, what's the synergy like out of the coming from startup investment? That's kind of the mixture of like just the traditional like merger and acquisitions and the startup investment. That's fine to discuss the synergies, but particularly, I think there's two cases, in terms of the investment decisions. One is these days, particularly in Silicon Valley, we see the trend that many of the big corporates are actually bringing bringing down the investment decision authority to the investment managers, so that they can be speedy, or obviously the investment managers in Silicon Valley can understand the trend fast. So, but many of the Japanese companies, they tend still like headquarters has to be involved in investment decision, which slows everything. So I think the either you want to be to get the strategic return, which tends to have like at least some proof of concept or prototypes for the headquarters to have to make a decisions in investment, which tends to be invest later stage. Versus if you want to have like a kind of financial return, then obviously you want to go early, even though it's more risky, but also you got to have a more financial return. So what I see, like Google Ventures, for example, for other like basically they're going to separate the team, headquarter-led traditional CVC versus kind of 100% limited partner type of the venture capital on the ground. So in the past, Japanese companies are mostly heavily headquarter-centric investment decisions were made, but these days we see some of the cases that we for example, like my firm is funded by Panasonic, but the investment manager is actually ex-partner of the Klein Perkins and also the ex-Intercapital, and basically Panasonic brought $100 million to us to make the whole independent decisions on the investment, which is kind of very unique to Japanese companies, but not unique to any other US European companies. So what I want to say is that is the kind of the reason to part of the reason to your question, but also there's some change of trend is happening even among Japanese companies.
Okay, just only one sentence. The things, I used to live in Japan, so the one thing that bugs me on corporates in Japan is that they're typically sending some engineer guys over to Silicon Valley just for 2-3 years.
That's right.
And then they take them back again. And I'm telling you, You want to play a corporate game in Silicon Valley, it takes you 2-3 years just to build the network. Right. Now they've built it and they go back. I think that's one of the big factors that sucks in Japanese corporates and sending them on a rotating basis.
So yeah, I'm going to advocate that. Yeah.
Our headquarters of our global VC firm often hosts visiting corporates going on their innovation tour. So, you know, sometimes they just stay for a week, let alone a couple of years. But in any case, yeah, you definitely have to commit. Startups are a long game. Innovation is a long game, but also a fast-moving one. So the investors, as usual, have been taking up all the time. We do have a couple founders in the room. One already spoke, but Vaibhav also has hopefully been on the receiving end of funders. How's your perspective on the dynamic of the investing landscape?
Thanks, Eddie. Always good to speak to or listen to the investors because they like to get their voice heard in any case. You know, what I'm going to do is spend 5 minutes, jot down a few points which I wanted to bring out and move away from, you know, very deep insights into venture capital and, you know, all of the jargon which has been thrown around in terms of numbers, et cetera, and provide maybe a more you know, laymanish and a more practical sense of a question which most people in the room might confirm in the affirmative. And if you go to any country and you ask a lot of people, most of whom might be serving in large corporations as professionals, as to where you see yourself or what you want to do in, you know, the next few years of your career, if you're not already ending it, is yeah, I would like to do something of my own, and you know, I want to get into entrepreneurship, etc. And with all of the VC money flushing around, as Eddie said, that you know, maybe there's enough capital, there's, you know, we hear about it, etc. There's this fascination and this belief that if I were to start a business, I would get money, and I'm the right guy, and I'm thinking of the right business, and you know, I'll find money. And I think this is where the challenge starts. And I've set out, you know, a set of 5-6 steps or events which make people think this way and which could inspire some thoughts on this panel as well as to the members who are participating and hearing us speak. So just a small background. For the first 10 years of my career, I was a banker and a consultant at McKinsey, KPMG. So I was advising businesses as well as funds. So I've seen both of those. Then I moved to the buy side. I invested around $400–500 million under my hand, sat on some 20 boards. And then I started this company, and I've raised money from a value-based investor. So I've seen the cycle through 3 or 4 different lenses. And I talked about the question on, you know, everyone says, yeah, I want to do something of my own. And then Eddie mentioned that, yes, there's this, you know, lot of capital, or so it seems to be. But is there ever enough money? And I think the answer is no, because if the number of people who you ask that do you want to do something of your own is so large, then, and if each one of them was to get a share of your wallet, then is there enough money? The answer is clearly no, which clearly means that every business is not a business which will get funded, and it clearly means that every business is not a business which is cut out for VC. You know, when you start thinking of your own business and you think of venture capital and I'll raise venture capital, you're thinking of your business. This is my business and I'll raise money from the venture capitalist. The problem is that your business will raise money from another business, and that business is the business of venture capital investing. So before you think of your own business and I'll raise money from the venture capitalist, you must also think that there is a venture capitalist on the other side who's serving the needs for his own business. And that business is also operating on certain parameters of payback and returns, fund life, et cetera, et cetera. And there has to be an inherent matching of their expectation and yours. It just cannot be, oh, it's my business, I'm the right guy, why don't you show up with the money? You have to also think of the business they are running. And if you're cognizant of the business they are running, then there's a higher probability for you to be able to align incentives, expectations in the right manner, that you'll create an environment which is conducive for you to be able to raise money. Once you've raised the money, let's say for a moment you cross that barrier. I think the big problem, which apart from just the physical capital, is human capital. businesses generally get germinated in the eyes, in the minds of one or two or three individuals who know each other, come together, start a business. But these three individuals are incapable of taking the business, and I don't mean, in some exceptional situations you might have some exceptional people doing that, but you need a team around you. And the problem is that if you're at an early stage and you don't have sufficient money in the bank, top quality talent's not coming to work for you unless they are inspired in a big way to make a change and feel vested in the organization, etc. So I think that's where the next big challenge comes. So it's one thing to say that I'm raising capital for my venture, but the bigger thing is how do I use that capital to get human capital, because that's the big capital which is going to make or break the business, not financial dollars, because those you might find friends, family, fools to start with, some institution after that, etc. And I think one more important point that must be kept in mind is the amount of capital which is available or can be raised by a business is also a function of the number of exits that are created for the industry as a whole. So unless the industry creates exits, they do not provide the next additional dollar to get in. And therefore, if we all recapitulate how we started the panel, we talked about exits, and I got the numbers from Martin, about 250 exits in excess of $100 million in the Valley, 49 in London, China, Israel, India. But what about the rest of the world? I mean, every room, every country is talking about, I want to do a business of my own, and if only 5 countries are to provide exits, then where is the capital available for all of these other countries? Finally, I would like, and I'll obviously come to my experience and how I felt, et cetera, but I want to close on the generic conversation around getting an exit, but also the timing of the exit. It's one thing to get an exit by the time either you're the living dead or the exit is inconsequential from a timing perspective. But 2 things here. If you, everyone thinks that if you're the business got a technology angle, the VC will come calling. But that's not true. In the large markets where there's a large domestic market, or if it's a large-sized country, or if it's already attracting a lot of capital, and let's say the US, EU, China, India, Israel, and maybe some markets like that, there is an opportunity to straddle the online-offline play, bring capital into play, and kind of bring in an element of technology and think that it'll become large enough, whether as a horizontal platform or a deep enough company, and it'll survive, and there are so many dollars which have already gone in, and just because the dollars have gone in, it'll stay alive, and some other VC will fund you, et cetera, et cetera. But in other smaller niche markets, unless you're doing something really deep tech, or if you're doing something AI, ML, or something which is highly productized and unique, I think there's going to be a challenge, because you can't become large enough for the VC to get an exit, and if there's no exit, there's no more money coming back into the country. If more money is not coming back into the country, more people are not able to do their own thing, as I said. So those were 5 or 6 things which I kind of wanted to emphasize about. The topic was availability of venture capital. I think just the capital itself and thinking of making capital available is just looking at the a full side of the glass. I think the empty side requires a lot of effort as well. And in closing, about my experience of dealing with VCs, I think I had the privilege of advising a lot of them in my previous life and then investing. So I think it was not so difficult, but having said that, till you don't have money in the bank, it's always very difficult. So I think across that path, I think interesting times for everyone who wants to do something on their own. And I think if that inspiration were not to be in the world or in this room, I think life would get boring. So I think I would like to close by stating that keep dreaming and keep thinking of building your business, even if you don't end up doing it.
Thanks. That sounded like the end of the panel, but we still actually have 25 minutes. So we were focusing a lot on the funding side, but absolutely need to jump over to the exits. And there's one point here, you mentioned bubble. To what extent do we on the panel believe that there is a bubble in venture capital worldwide? Some argue that there are still innovative ideas that are technology driven coming up around the world, especially in core markets like US, Israel, China, and therefore there should still be good opportunities and a healthy environment going forward. There are others who observe that there are many large tech companies that have reached paper valuations in the hundreds of millions or billions of dollars, but have not exited. And it's not money in the bank until there's an exit. So the question for everybody is there a bubble?
I'd like to take the first cut on this. My experience when I researched since 85 onwards the venture capital industry, at any given time, in any of the industries, in some of the geographies, there is a bubble. At any given time, even in a financial downturn, we looked at this. That means what? That means companies in certain spaces will get overfunded. That means there are too many Me Too's, and that's where the casualty afterwards comes in. So then you can look at the overall aggregate, right? Is there too much? So that actually also goes by sector and by geography, right? And so the one thing that, and just in 2 sentences, we looked at successful exits, because successful exits, as he said, will drive the next investments again, right? And so when we talk about tech or tech companies, the Western world has always been thinking of IP, because that's measurable by patents. But when we look at 110 unicorns, and the ones who made it, half of them had exited. And it's not published yet, but I'll share the result with it. So you have to look at 4 layers of innovation. The bottom is technological innovation, then you have product innovation, then you have process innovation, and you have business model innovation. And the most successful companies that sustained longer term, even beyond exit, they had 3 of the 4 innovation layers into one, the top 10%. And everyone, and that's the most stunning result, it even stunned me, is every single one included a business model innovation, and then 2 others. It doesn't matter which one it was. And the second layer had at least 2 out of the 4, but it also included in over 90% a business model innovation. So it's the combination of technological product or process innovation combined with the business model innovation that brings that massive sustainable position and strength in the market.
Can I? Oh, okay. I just wanted to add some other things. I think it's a bubble, first of all, and I think 3 reasons. One is I think it's a good thing as well, but again, lots of, as we discussed, there are lots of corporates going into CVC. So kind of the traditional innovation model of the big companies doesn't work anymore. So. But still, it doesn't say that even though the traditional corporates are involved in the startups, they can innovate themselves. It doesn't mean that. But still, the fact that corporates are going to see this corporate venture investment, it's one big thing. And also the second thing is more on the macro perspective. Is still in the past couple of years, global central banks, starting from Bank of Japan, ECBs, the Fed is now changing its financial policy as we discussed in this conference. But global liquidity is abundant. But I think, and also the third thing is the only hot thing from Japan is a SoftBank Vision Fund, which is so disruptive in Silicon Valley, and which is basically gearing up the valuations, etc. But I think why I'm saying it's bubble, because it's all related to macro. So if the global macro economy is going to down, the corporates right now they're very active, that they're going to start finishing, basically their investment activities are broadly related to the macroeconomy. So second thing, global liquidity. If the Fed is going to raise interest rates, etc., the current abundance liquidity is going to change. And the third thing, SoftBank Vision Fund, well, still they're going to expand. I don't know, but it's basically oil money. It's coming from Saudi Arabia. So it's also depending on the commodity market. So basically it depending on the macro. So if the macroeconomic situation is going to change, I think the investment trend is definitely going to change. That's one of the things we have to see. And the other thing I just wanted to also point it out is actually, it doesn't seem like not related, but one of my concerns is the current U.S.-China, broadly the trade wars. As you see, what the United States is saying is actually they're also going to prohibit, not just Chinese, but the global human capital, even top talents into the United States, and also particularly for China, they're going to try to basically push out Chinese top technology companies from the United States. If it affects broadly towards the human mobility between the U.S. and China, I think overall it's going to also affect, particularly for the Chinese startups, if they have kind of will to expand their operations in the United States. I think it will also affect their activities. So. Well, so it's not for the reason for the bubble, but that's the only one thing I wanted to add. Thank you.
Eddie, I would like to just a slight deviation from the topic. When you talk about inspiring innovations being talked all over, inspiring innovation, empowering entrepreneurship. Every time there is an innovation, wherever there is a technology, there is always an innovation thing. Suppose in case of the Air Force fighters, the third generation fighter, fourth generation fighter, fifth generation, it's always there's an innovation and upcoming. And when I talk about funding, it follows the same strict pattern. Initially, it's like bootstrapping, then from family, friend, foe, all those things, then the bank, then the angel investors, then venture capitalists, IPO. That is the only pattern where we can follow? Or is there any way of innovation to raise the capital? This is a strict pattern which has been following. Wherever there is always an innovation. So what is after IPO? How we can innovate new ideas, help the startups. After IPO, what is the next source of raising funds?
I'd like to speak a bit more about the capital winter. So in China, we've been discussing this since, I would say, mid-year this year. So I think there's a general consensus among venture capitalists and entrepreneurs that in Chinese we say winter is coming, or winter has come, for those of you who know the Game of Thrones series. And there's been a lot of talk about this. Now, what exactly does that mean? Like, a couple of things. First of all, in terms of the macroeconomic framework, regulatory framework in China, there have been a lot of big changes. I think in general, the Chinese government is sort of trying to restrict sort of monetary supply. So you see a lot of new tax regulations, for example, in China on venture capital firms. Previously it was 20%, and now I think it's going up to something like 35% for RMB funds. And this is like quite a recent thing. The second thing that we see is, as I think some of my esteemed colleagues have said before, a lack of liquidity. One of the biggest issues that GPs are having in the market in China right now is because the lack of liquidity, because a lot of them sort of can't exit, and also because of certain regulatory changes to how capital is held on balance sheets of sort of the large financial institutions, private equity, and banks, who traditionally have provided a lot of capital off balance sheet to GPs. GPs are actually finding it quite hard to raise RMB in the current market right now. So these are some of the, first of all, that's on the macro level. Now, just like in any financial crisis, what you usually see in times of, let's say, winter, is that there's a flight to the top. Right? There's a flight to the top. So what we do see is that we still see very big deals being done, but a lot of that capital in bigger check sizes are going to the top sort of players in that particular vertical. So this morning, for example, I was looking at a financing of an insurance tech startup. Still a sizable check, but it's easy for them to say because they're sort of like the leading player in that sort of in that sort of vertical. Now, I wanted to weigh in a little bit on the CVC debate just now, because I think Chinese corporates, especially Chinese tech companies, have behaved very, very differently from not just the Japanese, but actually globally, in terms of agility, in terms of nimbleness, in terms of pure and total speed. I think in China, I mean, yes, we know they're CVCs because they're part of Alibaba, Baidu, or Tencent, or JD, or Xiaomi. But I think they're seen very, very much part of the ecosystem. They're a crucial part of the ecosystem. So I was looking at, the number of just the total IPOs, this year. Many of the famous, I would say, Chinese brands have rushed to IPO this year, partly because of the fear of capital winter. And therefore, many of them are now saying it's now or never. So some of those notable names include Xiaomi, right? That the handphone maker includes Baobao Shu Baby Tree, the mother and baby media. It includes Haidilao, which is the hot pot a restaurant, Meituan, which is the sort of the services platform giant, and many more. And what's actually very interesting is that there was a very interesting ranking published in terms of which VCs had the most exits. So the top two were IDG and Sequoia, but then the third and the fourth were actually Alibaba's related funds in the ecosystem, and then the fourth was Tencent's funds in the ecosystem. So you can actually see that these so-called CVCs or funds in that ecosystem actually playing a huge part in terms of exits. The other thing as well that we see is that some of for example, something very notable, especially in the AI industry, if you look at some of the biggest players, best funded and also best performing startups, or the highest valued startups like Face++, Sense Time, you can see that they managed to reach that level because of investment from people like Alibaba. Because they happen to feel that niche, and also, in terms of just pure, if you're doing a B2B business, there's no way, you can really fully, in general, there's no way you can fully avoid, Alibaba or sort of Tencent, in terms of serving the ecosystem, and that can hugely change the trajectory of a small startup. The last bit I think is that, I think in China, like I say, the CVCs are very, very nimble, very, very fast. But the one thing, I tell all founders, whether in China or overseas, is that, first of all, usually, you have to choose one or the other. You're not allowed to sit on the fence. The second thing is that you need to figure out how early in your in your sort of fundraising play you actually want to bring them in. Too early is not necessarily the best thing, just because that might change your entire business model and how much you can scale. Yeah. So, but I think in general crucial to actually have them in at some point. Just because, just because in terms of like the massive ecosystem that they actually have access to. And then I also noticed some CVCs, like for example, Chuyen, which is the CVC of Xiaomi, is actually taking huge strides in India. Huge tickets in India this year, actually. Yeah.
I'm curious, do you have CVCs among your LPs?
Right now, no, actually.
Oh.
Right now, no. But
we do, so.
Yeah. Well, it's something we're actually considering. Yeah, especially for the ones who don't already actually have a presence in Southeast Asia, because like I say, the big ones like Alibaba, Tencent, they already do.
That's right. Great. We have 13 minutes left. Definitely want to leave room for questions. As a general observation, you can see there's dramatic differences in opinion, so please take this opportunity. Yeah.
I don't have a question, but can I make a comment? My name is Jay. I'm from Jungle Ventures in Singapore. A new model is developing, just initial stages of professionals who are employees of companies, how they are coming into the entrepreneurship world also. So there's an organization called EF, Entrepreneur First. And what Entrepreneur First does is they go out and scan the world of employee professionals. They talk to hundreds of them, and then they curate about 32 of them in a cohort, bring them into their office, they quit their jobs. Most of these professionals, they'll tell you that they have 3 reasons why they don't do a startup. First one, they need a paycheck. Second one, I don't have a co-founder. And the third one, I don't have a startup idea. These guys from EF find those people, the best of the technical guys, and 32 of them, they get thrown into a room, 8 o'clock in the morning on Monday, and by Friday, 5 o'clock, you have teams. Typically, there'll be 10, 12 teams that develop, and then over time, there are more teams, and some of them drop out because it's not for them. That model doesn't work. Those teams then go for 3 months. They get paid $5,000 a month by EF, and they develop a minimum viable product, and in 3 months' time, they start selling, and they start getting funding. At 6 months, they have a demo day, and 2 or 3 organizations fund every one of them who go on the demo day. Angel investors and venture capital guys, they come. These guys have done many cohorts already. They had one successful exit of Magic Pony, which sold for $150 million to Twitter. They had another one for $20 million, so they've already just started doing exits also. They started in London, they're now in Singapore, and now they're starting in different countries and cities. So it's Bangalore, they're going to Paris, etc. So there is hope for professionals.
Great. Other comments, questions? Yeah.
I'd like to ask a question.
Name and company, please.
My name's Wei from Malaysia. I also do my own investment as an angel investor, as well as now I'm sitting on the commission of the Malaysia Communication and Multimedia Commission, looking after the industry, which is communication and multimedia industry. My question is about the STO, because now I think VC as a business is perhaps better understood by a lot of people. And then the emerging trend that perhaps warrant the attention and the discussion could be the security token offering, because Arun spoke about ICO, that seems to have actually passed the window. But STO has a flavor of equity, and it also has the flavor of other benefits such as membership or privilege or purchase or payment that actually could be built into that the feature of the security token. So I just wonder what will be the comment of the panelists regarding STO? Would VCs invest in STO rather than just equity? And also, what does it take for STO to be more successful in the future, given that this is a trend?
2 points, and I think I'll leave it to others. The challenge we have with ICOs is that a lot of ICOs were more scams than anything else. So it leaves a bad taste already up front. The second challenge that we looked at on the research side was entrepreneurs that get the funding from ICOs, through ICOs, initial funding, have a harder time for a follow-on investment, right? And that is something entrepreneurs are often not aware of. So I think I'll leave it to other panelists. What it also means is a lot of startups can get money from ICOs, and that creates also a whole load of other Me Too's, which probably, and the venture capitalists would not receive the money. Good or bad, I'll let you judge it, but these are the 3 points I wanted to add.
Yeah. If you don't mind, I can expand on this a little bit, and then there's a hand in the back there. One moment, sorry. So ICOs, initial coin offerings, there are 2 main types, utility tokens and security tokens. Utility tokens are what you mentioned about membership or privilege or product or what have you. Security tokens represent some stake in the company, like an equity holding. Sometimes companies were offering a combined token that gave both. More often than not, they were offering one or the other. And usually they were trying to offer utility tokens. In either case, as Martin mentioned, most ICOs have failed. There was a huge thing early, and you saw in your data, like the ICOs had peaked earlier this year, and by middle of this year, a study had shown that more than 85% were scams. Outright scams. The ones that were not scams had collapsed, most of them had collapsed within 6 months, which when we're startup VCs, we expect a lot of startups to fail, but not in 6 months and not at that high rate. So definitely that's why there's a bad taste in the mouth around it. Also, there's this, for me as a VC, I wonder, there is a lot of venture capital money out there, and there are funds in all of APAC that are saying we can't find enough good deals. And so if there's a team that has a great product, a great concept with innovation along the pyramid, as Martin described, they should be able to get traditional venture financing. If they have to go to ICO funding, to me it raises a red flag. Why couldn't they raise from esteemed colleagues on this panel? They have to go out to the public, retail investors to raise money. Maybe there's some reason for it, but then when they're able to raise from the public is generally offering, maybe they're sharing on social media, but they're not providing the same kind of strategic value, the same kind of human capital that Vaibhav mentioned. And at the same time, they're often paying at higher prices than a venture capitalist might pay in a private transaction, which then makes it harder for them to raise the next round of capital. So you can start to see how everybody's comments have fed into this. Now, with all that said, I do think ICOs are solving some like structural challenges in the financing market. In the US, for example, right now you have to be an accredited investor, make a certain amount of money, have a certain amount of net worth to be able to invest into startups. But that shouldn't be the case, I think. I think retail investors, if they want exposure to tech innovation, should be able to invest into early stage startups with certain disclaimers and maybe like limit a certain amount of money that they can invest. But at least they should be able to access it. And ICOs democratized access to finance opportunities that way. So that's one example of how there are benefits to an ICO. But I think right now, the way the market stands, I don't think they have a very good use. Once it flushes out of the system and we start to see a higher ratio of quality projects, I believe ICOs can be, especially security tokens, can be the way to invest when venture capitalists may, for structural reasons, not want to invest in
maybe, Eddie, one sentence add-on. A study shows that second-time entrepreneurs raising an ICO, they have already gone through a first venture. They don't need that much the added value from the venture capitalists. So first-time entrepreneurs starting with an ICO without having built this don't have that experience. So the failure rate is dramatically higher. So if it's a second-time entrepreneur, I'm pretty okay if he has done a startup before.
So I think for the ICO, the credibility of the founder is much, much more important. As you said that, if like Jack Ma was somebody like in that league started an ICO, obviously people will get know more about the leadership. Then people will start investing. So we'll suggest leaders of that stage should come and start these things so that others can follow.
Just a quick one on the security token debate. Actually, I noticed a lot of my friends who are investing in blockchain these days are actually moving away from ICOs and security tokens, looking more at blockchain infrastructure, anything which supports the blockchain ecosystem, investment banks, etc., and also public blockchains. But on the security token thing, I think the only time where I would consider investing is if sort of two conditions are met. The first one is that it's like what Eddie says, right? After the initial flush, 6 months later, the entire value collapses. Now, to me, the only way that a security token can maintain its value is if there is, first of all, a pretty mature ecosystem. So there's a real use for the security token, right? It's not just like a speculative thing. So either it's a mature product where in the system already they're vendors and they're buyers, and therefore, if this is a real product, right, and it's not just an ICO, just for the sake of an ICO, then theoretically, the security token value will maintain. So one thing which I am, for example, looking at right now is a blockchain company for food security. So the blockchain technology is actually tagged onto an existing business, in terms of import-export. So regardless of whether there's a blockchain technology, they import and export like food anyway. And they have like hundreds and hundreds of vendors who will need to use the security token to buy the services of this import-export business. So in a case like that, regardless of the ICO or not, the security token actually should have some value, given that if as long as the business actually continues. So that's one thing. The second place where I see people still buying into some ICOs is when, for example, for certain exchanges, there's a limited supply of security tokens, right? And every quarter or every 6 months or so, there is sort of like a proposed or sort of guaranteed buyback of certain tokens, so that there's always like less tokens in the ecosystem. Therefore, I mean basically what the company or exchange is effectively doing is that saying, okay, we're going to make sure this security token is always going to have value because we're going to constrict the supply, sort of every quarter or so. In a case like that, then okay, there is some reassurance that given that the prospect of this business is good, there's already very good revenue, and they're going to buy back. It's like Apple buying back shares, right? Maintaining the value. So I think these are the only two cases where I would consider a sort of a security token. Yeah.
So thanks, folks. We have about 2 minutes left. We started a little late, but if anybody wants to run out on time for lunch, feel free. There's a question in the back here. Name and company first, please.
From the Philippines, and I basically just had a quick question on basically, what the when you arbitrage the delta from going from from private to public multiples, is there an industry average, based on the type of industry that you're in? And the second question would be, what is the extent to which reverse mergers are used as an exit strategy?
So, valuation arbitrage, it's interesting. Valuation is also driven by the growth of the company, right? Revenue growth of company and profitability. And I love to throw in that number, which I have not also published. So companies that have more, and with the exception of US, China, and India in the service sector, that it includes what I'm saying, India in the tech sector. So with the exception of those three nations, companies that have more than 50% of their revenue outside their home country, when they go commercial, in the first 3 years of commercial, they grow 2.1 times faster in revenue. And that drives also valuation. So that is one of the things. So industry arbitrage, I think, was another question you had, right? So there is a huge difference in arbitrage across different industries, right? From service particularly to tech, and even within there. And it's all a question of how intense is the market already populated or not, right? Are there a lot of startups in there or not? And then keeping startups longer private has another massive issue, which means those companies, the reason why companies are being kept by their investors longer private, that's a research I was involved in, is that in the old days you needed 15 years ago, you needed 20 millions or approx to go IPO, and about a year or two or at least a year of break even there, right? This has changed. So that means the people, when they went public, the public investors ripped off a lot of the value. And the VCs were now saying, wait a minute, we are spending 10 years on these companies. Why should we leave to the check writers in public all the gains? So we are keeping them an extra 1, 2, 3 years longer. We get enough private capital in, so the big investors who used to pick up the companies in public are now investing in them in private, right? Because that's where they can get the gain. The question at the end, to me, and I think that's exactly the point, is if the IPOs are no longer going to be that lucrative the way they used to be, are there going to be as many IPOs which are typically a higher valuation and a higher return for their investors? I think the industry is cutting and shooting itself a little bit in its own foot, right? By trying to keep them much longer. I'm not saying, I'm not in favor of one or the other. I understand the investor's rationale as well. But I need to highlight this because I never hear a discussion around this. So that's when I say valuation up is between public and private markets. There is a big question mark how long and what's coming out of keeping them so much longer private.
Great.
Okay, and the second question was, to what extent are reverse mergers used as an exit strategy for that?
Okay, so I have to admit that is not something I have researched, but maybe one or the other panelists who are investors can answer that question.
That's the first for Martin, by the way.
There's one instance, you mentioned you didn't see one, but there was a travel company based out of India which got invested by a very large US-based, well-known VC firm, and they did a reverse merger back in the US, and the operating business of the India company got merged back, and that's one instance. And as soon as that happened, not surprisingly, everyone started talking about such structures and trying to find opportunities in that space. And I think what's going to happen is that when there will be challenges around traditional methodologies of securing exits, structures such as those will come to play. They've not been very, very popular, not many examples, but this was one example. And as soon as it happened in India, suddenly, because of the fact that India has taken in a lot of venture capital and exits have been not so popular or not so common, I think such structures got sudden press, imminent interest, and I think there is likelihood that you might see more of those coming.
Great, thank you.
Thank you. There's one final.
Just for 2 quick seconds. What Martin just mentioned about how the industry is getting disrupted from public to private. For the VCs at the lower end of the spectrum, specifically speaking about India, there is a lot of grant money being available to the entrepreneur. And what that's doing is the entrepreneurs now are valuing equity over money. So same applies to you. What's happening to the public guys, how you're eating into their cake. I think the entrepreneurs are looking at the free money that's coming to you as a value that they don't have to give up to the guys that want the equity. As an ecosystem player, we used to charge anywhere from 2 to 7% equity, and we just have to give out free money now, just because there's enough government money out there that dilutes that whole spectrum.
Distortion. Okay, great. So we've heard that there's more capital now than ever before, but that there might be a global financial crisis on the horizon. Fortunately, there are multiple ways to innovate, including new organizations like Entrepreneur First. But anybody who wants to innovate should try to do so along 4 criteria that Martin laid out, especially the business model innovation, but also hopefully technical innovation, process innovation, and product innovation. When you hit 3 of those 4, please come approach the panelists.
Oh, sure, absolutely.
Until then, have a great rest of the day. Thanks for coming.
KIE.